Okay, this is part 4. This should be the final part for this presentation on the recording process. I just finished explaining Benford's Law. Like I said, it's a really interesting article. I have it posted out under the external links in Ocean Cruiser, and it's a Journal of Accountancy article about Benford's Law. All right, all I'm going to do now is show you the recording process as illustrated in your textbook. And I'm just picking a couple of illustrations. So first you're going to analyze the transaction. This is a transaction relating to cash. This person, Bird, is investing $10,000 cash in a new company. So Bird is creating this advertising company called Pioneer Advertising Agency. So there's the transaction. We're analyzing it. There's the basic analysis below it. Asset, um, the asset that we're going to affect here is cash, right? Remember what I told you, every time you see the description of a transaction occurring, look to see what's going on with your cash. Is cash coming in or is cash going out? In this instance, cash is coming in of $10,000. Owner's equity will be increased by the $10,000 because Bird wants to keep record of how much money has she given towards this advertising agency. Okay, then the next step we'll look at the equation analysis. So we're still analyzing this transaction, and we'll use the accounting equation: assets equals liabilities plus owner's equity. Assets, cash is an asset, so we're going to increase cash by 10,000. And then on the other side of it, we're going to increase owner's equity by 10,000, the capital account. I'm sorry, guys. I'm trying to make this recording good. I don't know. Sometimes the microphone might be going a little out of whack, but keep listening. I think it clears up every once in a while. But anyway, okay, we're back to the equation analysis. Assets equals liabilities plus owner's equity. Then we'll look at our debit credit analysis. Again, we're still analyzing this transaction, and this is just helping you mentally how you're going to go through a problem. You're given the description of what's occurring in the transaction, and then the process you can take to try to journalize this transaction and then post it. So we're at the debit credit analysis. If I want to increase an asset, asset is on the left side of the equation. Left means debit. So I'm going to debit an asset account, the cash. Capital, I'm going to increase my capital account by 10,000. Owner's capital is on the on the right side of the equation. I gotta get my lefts and rights correct. Owner's capital is on the right side of the equation. It might increase a capital account right. Right side, right means credit, so I'll credit that account. And finally, after we analyze all that, we're going to create the journal entry. So here, it's on October 1st. We have to put the date. This transaction occurred on October 1st. We're going to debit cash. With every journal entry, you want to list your debits first. The account I'm going to affect is cash. I'm going to increase it, so I'll debit it by 10,000. Then I'm going to credit my capital account, CR Bird Capital, that's the owner's equity account. Then I will increase my owner's equity account. An increase to an owner's equity account that's on the right, so I'll credit it by 10,000. So there's our journal entry. We're journalizing this transaction. Notice our credits, we indent them in the account title field. You indent your credits, and then you'll record that credit. Then, once we journalize the entry, we want to post it. Cash is being debited by 10,000, so I'm going to go to the general ledger, to the cash account, and record this debit of 10,000. Then I'm going to go to the capital account this credit of 10,000. Right, so everybody see the recording process. First we have to analyze, then we have to journalize, and then we're going to post it to the general ledger accounts. This next one shows where we're receiving a cash advance. And the reason I'm pinpointing these is because we're going to go into more detail with the unearned revenue and prepaid accounts in Chapter 3. So this is just an introduction to it. So we'll go into greater detail in Chapter 3. But one of the problems that we're going to cover has these type of transactions. Right, so on October 2nd, Pioneer receives a $1,200 cash advance from a client for advertising services. We haven't performed the services yet, so we cannot record revenue. If I did not perform services, or if I did not incur an expense, I cannot record it on my income statement as of yet. So in this instance, as of October 2nd, I'm receiving cash, so I'll record cash, right? I'll increase my cash by this amount. But then what I want to credit is my unearned revenue account. Remember that term, unearned, means that it's a liability account. And if you think this through, this cash advance from this client for services, if the client decides that they do not want us to provide this service, say in October they come to us, or they come to us in November, or even if they come to us in December before we even complete the services, right? We should complete them by December 31st. We haven't even started yet to provide advertising services to this client, R Knox. We are liable to return that so-called deposit, that cash advance of 1,200. So that's why it becomes a liability. Right? So keep that in mind when somebody gives us a cash advance. We're going to record a liability for that until we actually earn that revenue. When I do, that's when I'll record it to my revenue account. Right now, it's a liability. So if you look down to the journal entry, there's October 2nd, I'm receiving the cash, so I'll debit cash, and then I'm going to record this liability. Unearned revenue account is a liability. Liabilities are on the right side of the equation. If I increase a liability, I'm going to credit it. Right means credit. So I'll credit it for 1,200. Also notice every journal entry, my debits and credits balance 1,200 debits, 1,200 credits. Then I'm going to take that journal entry and I'm going to post it. So if you look at our cash T account in the ledger, we see our first transaction of October 1st where we debited 10,000, we received 10,000 from the owner. But then also October 2nd now, I have this other transaction that I'm going to post of 1,200 debit. Look on the right side, there's the unearned revenue account. It's a liability account. So I'm going to credit that for this transaction on October 2nd. So that's where you're posting. First, you're going to create the journal entry. Then you're going to go to each specific account and post that entry to it. All right, and then let's look at this one. October 4th, Pioneer pays $600 for a one-year insurance policy, which will expire next year on September 30th. Okay, this is the reverse of that revenue. This is a case where we're paying, so cash is going to be reduced. So I'm reducing my cash by 600. But this is a benefit. I have not incurred this expense yet. This is a one-year policy. When I incur this expense every month, I may take a piece of the 600 and record it as an expense. But right now, it's prepaid. I'm prepaying my insurance. And so I'm increasing that asset account. Remember, prepaid in any title means an asset. So there, my cash is being reduced. My prepaid insurance is being increased. There's the journal entry. You guys can go through this. I'm running out of time. I just want to look at one other transaction. This is where we hire 4 employees to begin work on October 15th. As of October 9th, nothing has occurred. There's no transaction for me to record. They did not begin working for me, so I do not owe them anything. I do not record an entry. So a business transaction has not occurred in this instance. As as of October 15th, when they start working for me, then I am liable to pay them, and I will report a transaction. All right, these are all in your textbook. They're a really good illustration, so you want to go through them. And that's it. We're done. The end.